Now, when Greek and other European leaders came to the 17th hour of the all-night talks that culminated in an agreement Monday, their immediate concerns were economic. But experts say there were also serious strategic issues driving them toward the accord. VOA's Pessin reports from London.
The leaders avoided the unprecedented removal of a country from the common euro currency and possibly the European Union, a result experts say would have had broader implications.
That would mean that the European Union, not only is it not an optimal currency union, something that economists have already stressed, but it's also a very profoundly dysfunctional political project.
The accord will cause more hardship in Greece, but experts say an exit from the euro would have been worse, not only for the Greek people and Europe, but also in geopolitical terms if Greece fell into economic depression and social unrest.
What will happen within Greece and also its geostrategic orientation if there is a catastrophic event of dramatic proportions that Brexit might be.
Already, the new Greek prime minister has made conciliatory moves toward Russia, and the Russian president reportedly tried to convince him to veto the renewal of European Union sanctions imposed on Russia for its involvement in Ukraine. The new Greek defense minister participated in a Moscow conference with his counterparts from Iran and North Korea.
It is absolutely causing alarm bells in Europe, but it's more, I think, the symbolic nature rather than any further sort of strategic partnership for now.
But analysts like Sarah Lane, who spoke via Skype, point out that while financial markets welcome the difficult deal with the EU and it can have a positive long-term impact, Greece can't rely on Russia for much help as it struggles with its own economic problems. And they say it would take a lot of upheaval for Greeks to look to the east for their future rather than the west.
Russia might be a profitable commercial partner, but it's not the model that Greece should follow.
And experts say that broader concern led key non-Eurozone Western powers like the United States and Britain to push for a settlement and avoid the possibility that a financial dispute could lead to a geopolitical shift. Pessin, VOA News, London.
Let's continue our business report and go to New York, where Africa 54 business correspondent Alexis Christoforous is standing by. Hello, Alexis.
Hello, Linord.
First off, before we talk about Greece, let me ask you about today's story we covered earlier, the Iran nuclear deal. How are all oil markets reacting to this?
Well, oil prices started out lower, but they've since stabilized. Traders are really trying to wrap their heads around this landmark deal between Iran and world powers. Crude oil was trading below $51 a barrel a little bit ago, but has since bounced back to above $52 a barrel. Just how oil prices react in the near term depends on how successfully Iran can raise production and sell the oil in the face of competition. Analysts say the expected rise in global supply has already been priced into the market over the recent weeks. And as we discussed, under the deal, sanctions imposed against Iran would be lifted in exchange for curbs on Iran's nuclear program. We could start seeing about 1 million barrels of Iranian oil hit an already oversupplied market in the matter of months. And of course, this deal could also potentially give global companies such as technology and oil firms, even financial service firms, a foothold in the lucrative Iranian market. Linord?
And quickly, how are U.S. markets reacting?
Well, U.S. investors are digesting disappointing June retail sales numbers today. On the bright side, J.P. Morgan Chase is reporting better than expected earnings, and Micron Technology stock was up about 10% on unconfirmed reports that a Chinese tech conglomerate is preparing a $23 billion takeover bid for the U.S.-based computer chip maker.
And what about Greece? What can you tell us in terms of update?
Well, national parliaments in parts of Europe will be voting on a new austerity package for Greece on Wednesday in exchange for its third bailout in 5 years. Meantime, it looks like Greece is looking to its tourists to help pay off its debts. The Greek government is expected to impose harsh new tax hikes on food, hotels, theater, even water, and those taxes are expected to get passed along to consumers.
Now, Alexis, we hear that Starbucks is coming to sub-Saharan Africa.
That's right. Some Africans will soon be able to order a cup of Starbucks coffee. The Johannesburg-based franchisor Taste Holdings has been given the exclusive rights to develop Starbucks outlets in South Africa. Those stores are set to open in the first half of next year. Taste has the license to operate the shops for 25 years, plus rights to open in some other African countries. That news sent shares of Taste Holdings soaring 20% to a record high. And this deal means that Starbucks can now sell coffee for the first time in some of the same places where it sources it. Starbucks currently sources its coffee from 9 African countries, including Ethiopia, Rwanda, and Kenya. Linord.
Well, interesting developments there, Alexis. Thank you so much for joining us. And Africa 54, Alexis Christoforous reporting live from New York.